Hello, this is Joe Slezak, Director of Marketing and Business Development for H2R CPA. Thank you for joining us today. The Q&A session will occur at the end of the presentation. For this webinar, the chat feature has been disabled and any question must be verbalized by the audience member at the end of the program. Please note that this presentation is being recorded for marketing and archiving purposes. I will now turn over the program to Paul Rudoy. Thank you.
Thanks, Joe. And thank you to everybody for joining us today. Hope everyone is staying healthy and well in this very challenging time. Happy Friday the 13th. We hope this isn't a scary presentation, but a presentation of awareness, and that you'll get some thoughts out of this. We're going to touch on ideas for you to consider for yourselves, for your families, and for your clients, and basically cover three areas. One will be legislation that's already passed and occurred, the Secure Act and the CARES Act. We'll talk about potential planning ideas that really existed prior to the CARES Act, the Secure Act, and the pandemic. And then we're going to talk a little bit about some thoughts on what's going to happen in the future as far as estate planning goes. So the other speaker today will be Todd Arbutina, who's one of our partners at H2R CPA, and also the managing member of 3 Chord True Wealth Management. And so I'll turn it over to Todd to give an overview of what we're going to do today as well.
Well, first of all, thank you for joining us today. Really appreciate that. Again, my name's Todd Arbutina. Just a brief bio about myself. I for many years have practiced as a tax CPA. I'm still a CPA. Started many years ago with a firm called Arthur Anderson. So for those of you who can go back that far, that's a good long time. Very blessed with the learning I had at that firm. But I was predominantly a CPA tax focus, but I also was an auditor for 3 years. So I was on the dark side on that practice for a while, and that's just a little joke for our auditors are in here, but I learned a lot. And about 15-20 years ago, I pivoted to a large degree and added wealth management to our practice at Arbutina. And then fast forwarded to this year, we merged our CPA firm with H2R come January 1, and I have taken over the role of managing our wealth management practice called 3 Chord True Wealth, which I'll get into that a little bit more in the back end with the presentation about the Roth. So it's great to be here, and thank you for taking time out of your busy schedules to listen to Paul and I and discuss about some potential planning.
Thanks, Todd. So the first area we're going to touch upon is the Secure Act. So the Secure Act is a legislation that was passed last December 19. So pre-pandemic, pre-everything we're involved in now as a country and globally. And so the idea, some people believe the idea was to add some nice elements for people in retirement, and that did occur in the Act. Items like not having to take a required minimum distribution till age 72, and letting people beyond 70 and a half contribute to an IRA. And there's some other nice features as well. But the real negative feature of this act, and a lot of people think it was to pay for our deficit issues that existed pre-pandemic, is to eliminate what's known as the Stretch IRA. And Stretch IRA was a wonderful generational savings tool where when you pass away, you would leave the IRA to the next generation, and they could stretch out the withdrawals on that over their life expectancies, and therefore your IRA could last generation after generation. Well, the Secure Act was in this aspect, is a very significant tax increase for anybody who was hoping for that to occur. Before, you had the choice essentially of taking it over your life expectancy or within 5 years. Now, for non-spousal beneficiaries, you have to withdraw the entire retirement account in 10 years. You don't have to take it ratably. You could wait till the 10th year. You could take it in the first year. But this will drastically change what the income tax that beneficiaries will pay on IRAs. So just a quick example, a $1 million IRA, if you had kids or heirs that had a 40-year life expectancy, they would take out $12,500 a year. And that IRA would continue to grow because, at least in the recent couple decades, you're generally going to earn more than that a year in the IRA. So it would continue to grow and last generation after generation. But with the Secure Act, you have to empty the whole piece out in 10 years. So in essence, what's going to happen is, you utilize the example that I have on the screen, is the total tax in that 10-year period for your heirs will roughly quadruple, depending on their tax brackets. And again, the value is not going to be there. This IRA is not going to last generations and generations the way it did before. So some ideas to look at to address the Secure Act issue of not being able to utilize the Stretch IRA. One item is, many people want to do something charitable in their wills, to give some dollars to a special charity or what have you. So what you should consider doing, because of the elimination of the Stretch IRAs, instead of putting it in your will, you might want to make the charity a beneficiary of your IRA or your retirement account, and let your heirs, children, whoever that may be, inherit all your non-retirement accounts, because they're not going to be paying income tax on the inheritance of those accounts. So that would be one item. The other is, you might want to look at the tax brackets of your children or your other heirs, because some of your children might be in higher tax brackets than others, and you might want to move assets around. So if you have one child that you have two kids, and one's in a very high tax bracket and one not so much, you might want to say, well, I will leave the lower tax bracket child a little bit more of my IRA. I will leave the higher tax bracket more of my non-retirement accounts, your stocks and bonds in your own name, or possibly real estate, those sorts of things. But on the other end, if you are concerned about your kids having to pay this much income tax, it might be a good utilization. If you were anticipating getting some money to your kids to be able to live off or supplant their earnings with your future retirement accounts, you might want to look at life insurance to be able to enable the kids to get the inheritance they were getting before. So the next item is, it's just only one slide, but it's relatively complicated and changing quite rapidly. So currently, we have a federal state exclusion of 11.58 million per person. It's scheduled to go up to 11.7 million in 2021. There has been some discussion of dropping this number to 3.5 million, and that discussion is totally speculative. That is the number that you see from what most people refer to as the progressive part of the Democratic Party, saying that's the direction they want to go in. The Biden proposal was to take it back to the pre-Tax Cut and Jobs Act number, which would be 5.6 million. So where it ends up is going to be speculative, but we'll see where it goes. But if you have an estate that's over 3.5 million, or if you're married over 7 million, you should really look at making some gifts by the end of the year. And if I had reviewed your estate in 2019, I probably told you at that time, you're going to be okay to 2022, because the norm would be 2021 is going to be a year for the new administration to deal with all the changes and the various political party ramifications, and by the end of 2021 they'll come out with a tax bill that will make sense in 2022. And that's what happened 4 years ago. The Tax Cut and Jobs Act took all of 2017 to work out. But with our serious deficit issues and with the cost for the pandemic, it wouldn't be surprising if we did have retroactive changes. So even if this occurs halfway through 2021, they could make the change back to the beginning of 2021. So that's why it'd be really important if your estate is over the 3.5 million or 7 million, you really look at gifting. The annual gifting limit is $15,000. And that just means you gift and you don't have to do any reporting. But you can go over that up to the 3.5 if this happens. But right now you can go over the 15 and go to 11.58 million. So it would be really important to look at that. Second is another factor you might want to consider is going to gifting appreciated stock to charity. Some people say, I got this stock, it's gained so much, I don't want to ever sell it because I have to pay so much capital gains tax, but I really don't like it that much. So if you give that stock to charity, you get an income tax deduction on the fair market value and the capital gains goes away. So again, the other issue that's always important to look at in looking at your federal estate plan is the liquidity of your assets. And many people have substantial assets that aren't necessarily liquid, such as real estate and business ownership. So if you're in that situation, you really should look at, especially with the state exclusion going down, is look at some life insurance to supplant that so that can pay your estate tax as opposed to having to sell real estate or sell business that would be a forced situation should you be taking a large discount. And then the next area I'm going to go into is a little bit confusing, and this is something that's been around a long time, and it's two relatively unattractive ideas that together are very attractive. And people have different names for it. I just call it the Life-Annuity Plan. And this is a way to immediately take money out of your estate. So if somebody has a lot of cash or a lot of income assets, where selling those or liquidating those don't create a significant income tax, this is a great idea. This is predominantly for people in their 60s and 70s. That's the target group where this is really valuable to. The downside to this is why you wouldn't want to do them individually and why they're unattractive. A life annuity means you write a check to an insurance company and they pay you an amount for the rest of your life, and it immediately leaves your estate. So that's great from the estate side, but if you don't live to your life expectancy, you just made a lot of money for an insurance company. So therefore, you want to combine this with a life insurance policy so that your heirs will end up with the same assets you got before you did this planning idea. So here's a quick example, and this is one that I did in August, as you can see on the screen, and but the numbers haven't changed because interest rates are virtually unchanged. And these are for a husband and wife in their mid-60s. So the idea is this is on $1 million. So they would take $1 million of their income portfolio, so bonds, money markets, cash items, and move that into an annuity for life. So the good part of that is you get a check, depending on how you want to set it up, every month, every quarter, every year, for the rest of your life. It's fixed. So these are assets that you say, I'm not as comfortable with the equity markets, but I'd like to do a little better than my 0.6% in my money market account or 1 or 2% on my bonds. Then, but again, it is for life, so you want to protect that for your heirs, so you buy a life insurance policy. So in this example, and there's 4 cases because we had 4 different insurance companies propose on this, is that for the $1 million, the premium is $14,719, and then the varying annuity payments. But the bottom line is the net return is in that 3%, anywhere from 2.81 to 3.39 in this case. And so you're going to get a higher return than you would normally get from your normal income portfolio. And that $1 million or whatever the number is immediately left your estate. So if you're in a taxable estate situation, the estate rate is 40%, and with the potential drop in the exclusion, it's going to hit a lot more people. Plus, if you're a Pennsylvania resident, you're going to be paying, your heirs are going to be paying 4.5% to 15% in tax. So if you're leaving for your kids $1 million, in this could immediately reduce a tax of somewhere around $430,000 from your inheritance group having to pay. Now, the downside of this is that there is a principal liquidity elimination. When you write that check, you get this payment for the rest of your life, but you can't get the principal back. So you have to consider that this should not be money that you would want to be able to buy a vacation home or some special spending account. So this would be ideally fixed income money that you're looking to reduce your overall estate numbers. I am now going to turn it over. Sorry, I'm sorry. I had one other topic I had to go. Very important one. And this is not new, but this is probably the most common estate problem that I've seen in dealing with estate administration. A lot of people think your will is the most important document that you will have, but that is not necessarily the case, depending on what your assets are. More people now have their wealth in retirement accounts as opposed to individual accounts. But regardless of your situation, your will does not play any role in your retirement accounts and annuities and life insurance policies. So what controls who gets that money is the beneficiary designations. And if you have a first marriage and you have the same children and everything is intended to be equal, it's most likely this is not as big an issue. But if you're in a second marriage and you have different children, or you have some unique aspect to it, your will and your beneficiary designations may not be together. An example I had just a short time ago for an estate we were administering, somebody did a very elaborate, everybody got along wonderfully. Husband and wife both remarried after their first spouses passed away. All the children got along well. He had a very significant 3-4 pages in his will about how the income was going to be allocated to try to be fair to everybody. But what happened is he started spending at a little higher level because he had some health issues. So by the time he passed away, his individual accounts were worth very little, but his retirement accounts were significant. Sole beneficiary was his second wife in that account, and his children got very little out of his estate. Now, the second wife in this case was very nice, and she said, I know that was not the intention. So she made gifts to the children of her second deceased spouse so that there was some equality, but it was quite complicated, and you can't always expect people to go to the length that this person did. So it's really important that you look at your beneficiary designations at least every couple years, if you haven't done that. And certainly if there's a life event, if you get remarried, if you have new children, if your children get married, or whatever that aspect is, because this can cause your assets to go to people that you really did not intend the way to be allocated. And nothing is worse than having spent a lot of money with attorneys or with accountants or someone else to put together an estate plan, and then the reality is the plan does not support what you really wanted because the assets aren't in the same bucket. So again, look at your beneficiary designations at least every couple of years and make sure it still makes sense with the assets you own and your family situation. Okay, now I'm going to turn it over to Todd. He'll go over an important part about the CARES Act.
Hey, thanks, Paul. That's a really great segue as to what I'll be discussing. And really, for some of you out there, I know that I got some clients and we have some staff on the call with respect to our new branding of the wealth management practice. We're in the midst of that, the 3-chord true wealth management, and those chords, which really represent what Paul was talking about. He touched upon insurance and tax issues. And then what I'll be talking about a little bit is the investment chord that, in a vacuum, looking at each in just a vacuum, you don't necessarily provide your clients yourself the best possible true wealth outcome. But when you weave together good knowledge of tax, insurance, the appropriate use of insurance, and the investment aspect, you really come up with some pretty cool and interesting outcomes for your clients, and that's what it's all about. What I want to talk about is, again, Roth conversion. So the first line says the benefits of converting a traditional IRA to a Roth IRA. It's important probably to define a couple of those terms. So I think most people know what an IRA is. It's a place where we can deposit funds in the traditional IRA on a pre-tax basis, we hope, in most cases, where we get a tax deduction for those funds, and Uncle Sam subsidizes those monies. And then that money grows tax deferred for many years until we're required to take it out. And Paul alluded upon to required minimum distributions. We have a lot of moving parts there. That age was just pushed back, I believe, to age 72 now from 70 and a half. The RMDs have been put on hold through the CARES Act this year, but the required minimum distributions are coming back next year. But again, we are in a lot of change, political change, and most likely tax law changes here. We're still in a pandemic, and so the future is a bit unknown, but that's our job. Our job is to work with all of you and with our peers in the tax practice that we're for our clients. So the traditional IRA, our money's put on traditionally in a pre-tax basis, grow tax deferred. A Roth IRA, you don't get the tax deduction, but those monies grow tax-free. And tax-free, there's nothing better than that. So that's what a Roth IRA, the name came from a senator, I think, from Delaware. So he's forever indelibly known for that particular legislation. So again, I alluded upon the fact that to the extent you have money housed or stored within a Roth IRA, you enjoy tax-free withdrawals during the accumulation phase, but all the way through, frankly, to death. And if you're a spouse, you can continue that on under the current law. I mentioned it gets to grow tax-free, no RMDs. And you can leave an income tax-free, probably left out a key word there, leave an income tax-free inheritance to your heirs. And those heirs could be your children or grandchildren. It used to be great that you could possibly give these monies to your grandchildren and let them extend the payment terms over their lifetimes, which would really provide a powerful outcome, which I'm going to talk about a little bit of a case study to bring this to life, make more understandable. So now, heirs must take RMDs. When I'm talking about children, grandchildren, and that period of time is much shorter than it used to be with the recent law changes, which Paul talked about. Again, I put a big caveat that these rules could change a few times over in the coming years, but that's our job to monitor that and work with our clients and make sure there's proper planning being done. Okay, key considerations. If you do a conversion, and the mechanics of that on the wealth management side, it's pretty easy nowadays. You can almost do it virtually with a form over the form online, and simply just transforming, converting dollars from the traditional IRA bucket over to that Roth IRA. How it's titled. Now, that conversion process, you can't do that for free. You need to move, and I'll use $100,000 as an example. You need to convert that over and pay income tax if you were to use $100,000 at your current tax bracket. So it's obviously going to be considered to be taxable income for federal purposes. So we need to watch brackets. And I wrote some notes down. This is really what I call a bit of a bracket game, that we make sure that we find sweet spots and we understand, what that tax consequence is going to be in terms of how much you want to do in a particular year. So I thought I'd do a little case study to better put this, make it more understandable. So quick case study is a couple, 40 years old, and the one spouse has been taking care of the 4 kids. 2 are ready to go to college. And the other spouse has made a really good living at that point. They've been excellent savers, even at a young age. But that spouse decides that they want to go back to school for 3 years, and there will be no income coming in the home. So the spouse calls me as their tax advisor and says, well, I guess I won't be needing to file an income tax return for the next 3 years since I won't be having any income. And I, as their wealth advisor and as their understanding the tax code, said, absolutely wrong. We definitely want to be filing an income tax return for these next 3 years because you have 2 kids going into college, and we have the opportunity to take that $400,000 401k rollover that you have in that one bucket and convert that to a Roth IRA. And in that particular instance, we were able to move over the full $400,000, or I'm sorry, it's $480,000 from pre-tax money to Roth funds, and the total cumulative tax bill over those 4 years was 0. So that was an opportunity which, if we just were simply in a vacuum of looking at an income tax situation, we really would have missed the boat with that client in terms of doing true wealth management. So in that particular case, and maybe you can jot down the number. So for a young couple like that, where we converted $480,000 at age 40, and we're using a 45-year joint life expectancy, which is 85. I think I'm actually being a little bit conservative there. And this is where you need to start making assumptions. And I assume that you'll make 6% on average. So you're putting in principal $480,000 over those 4 years. Just jot down real quick what you think that would have grown to by the age roughly of 85 in terms of future value, which will never be taxed. So just jot it down. Don't calculate it. You can do that probably in about a minute or so on the internet, but jot that number down. And I'll give you the number here in just in a second. So jot it down. So the long story short is, by doing that Roth IRA conversion and not just simply giving tax advice that you don't have to file an income tax return, this particular case study, that money would grow to be $6.6 million, $6,607,013.20 to be precise. So I think you probably know that's not just a case study. That's a real life example of one of the planning, true wealth planning ideas, what we've done with a client in the past doing a Roth IRA conversion. Extremely meaningful to that client. Should remind them every year, especially now that we're 20 years down the road, that that is going to serve them potentially very well as their children. So I hope that's kind of giving you an idea of where, that in particular situations you need to look at opportunity with the tax code to do a conversion. So bringing it down to the folks on the call here today. So really what I am highly recommending, that it may not apply to you this year, but you may have a sibling, a very good friend potentially, or maybe they lost their job. Maybe it's temporary. Maybe their income was down this year, that it would make sense to do a partial conversion of their IRA dollars. I will not disclose, but I have a client on this call today. Back in March, when the markets were tanking, we were on a weekly basis, we mentioned a number of times that would have been a great time to convert some traditional IRA dollars when the market was way down, artificially pushed down, into Roths. We had a few take us up on that, and it worked out really well because you were converting dollars when the market was down and you captured the upswing. I will not ever say that we saw the upswing coming as sharp as it was, but truthfully, $3 trillion of stimulus has amazing things, in terms of helping the economy hold its its leg under itself. So in any event, I hope that's making sense in terms of when we say Roth IRA conversion, we're looking for opportunities to essentially accelerate income into a particular year. And frankly, before the election, we thought that this would be even really make sense. But the election results are at least in our mind, I'm with Paul on this, is that that rates in 2021 may not be ratcheting up as quickly as we thought. However, with that known, I am still encouraging clients who have certain types of income events where we have a soft spot where we can convert dollars, say like in the 12% bracket. And we do have those people who are retired and so forth, not too many, but where it makes sense to convert, pay tax today. And what that means is we prefer that you don't take the money out of the Roth conversion, but you need to have side funds to pay those taxes to have the entire converted balance work for you tax-free. But we're essentially scouring our clients right now between now and the end of the year. And for those clients who are identifying this makes sense, we are having these conversations. And it always makes our Christmas, Nick's on the call here too, our last week or 2 weeks of the year, probably by far the most busiest, not the most happiest, joyous time of the year, as we try to figure out capital gain harvesting strategies as well as these Roth conversion strategies. So hopefully that case study is at least showing the power of Roth conversions in terms of how it can change just a mass affluent typical client of ours, depending upon their circumstances. So that's essentially what I wanted to discuss in terms of Roth conversions. And again, I thank everybody for attending, and I guess Joe will go the questions right now.
Yes, thank you, Todd. As I referenced at the beginning of this program, the questions do need to be verbalized for this particular presentation. And to do that in a formalized manner, for those individuals on their computer, I ask that you raise your hand. To start with that, though, we do have a few callers on the phone who don't necessarily have the ability to obviously raise their hand in that manner. So what I'm going to do here is I'm going to unmute the callers just to give about 10 seconds, see if anyone on the phone has a question. If no one does, your silence will let me know that, and I will remute you and then revisit the rest of the attendees. So I've unmuted the individuals on the phone. Once again, if anyone has a question on the phone, please feel free to speak up. I will wait about 10 seconds before I move on. Okay. Doesn't sound like there's any questions.
Yeah, while we're waiting, Joe, I'll go over a couple items that were mentioned in other pieces that we may not have covered. I think somebody submitted a question in advance about considerations with A, B, or bypass trusts. And so in terms of that has a very limited use anymore, because they were very popular when there wasn't the strategy known as portability. And that involves where people were concerned they weren't going to have enough in their own estate for their surviving spouse. But now with the application of portability, you can say, if I didn't use all my exemption up, I file a portability election and take it over to my spouse. So most of that won't be necessary anymore. There could be reasons you want to create a trust because of spending controls and other matters, but for estate tax purposes, really no reason to have an AB trust or a bypass trust any longer.
At this point, there has been...
Hey, Joe, I have one last one. I want to make sure, folks, I didn't really go into, on your individual situation, there are a ton of calculators, Roth conversion calculators, if you Google. And so if you have some personal modeling, because at the end of the day, you need to model this, and there are assumptions that you need to make, but there's lots of calculators you can find online. And essentially, what you need to model is the given. You know what your date, you know how old you are, you know what your Roth, your IRA balance is. What you don't know, unfortunately, you know what the current tax law rates are. What you don't know, where you need to make assumptions are, well, what's going to be the average income tax rate for the next 30 years, or depending upon your time horizon, what's going to be the average rate of return over the next 30 years. So there are assumptions that have to be modeled in, but in general, the longer you can let money grow tax-free and pay that initial tax today, that time frame, it works out mathematically that you'll be better off doing the Roth. But there are calculators and there are assumptions that you need to make that are reasonable, that will allow you to draw a relatively reasoned conclusion today as whether or not you should do a Roth conversion. And the last piece, we didn't go into we can get really into the weeds and do some pretty cool planning, because you can do this via your 401k if you're 55, but it's very specific to the terms and conditions of your 401k, that where you may be able to take a in-service distribution, convert to a Roth, and get to the same place, and after-tax contributions. So there's a lot of more specific situations that we have dealt with that get pretty complex, but I didn't want to go into that today. But modeling and working with, quite frankly, with a professional who understands these intricacies on both the investment and the tax side, and that's kind of what we've put together with our practice, is very helpful in making those determinations.
Thank you, Todd.
I just want to emphasize too on the Roth conversion side. Todd mentioned maybe for people who've had a bad business year or had lost income this year, but it's also really important for people that are foregoing their required minimum distribution this year. So this could be a good year to take that Roth conversion and be able to replace the same income you usually have and utilize a lower tax bracket. So if you usually take an RMD and you're not taking one this year, you really should look at that Roth conversion and see if it makes sense for you.
Thank you. And Nick, I believe you have a question. If you want to please ask your question.
No, Todd actually just answered it about the with the 401ks getting into the weeds, but it just a comment. It is very plan specific, and we have uncovered that with a couple folks that they didn't even know they had that option within their 401k to be able to do that. So it's very important to look at your plan documents.
Yeah, and one last word of warning, because if you try to do this yourself, you can't just focus on income tax. I know we have a few clients on here. We have to be careful if we do conversions, or if they're in such high tax brackets already that we don't, for instance, do a conversion, say, okay, we did a conversion for $30,000 for some reason, but you just got hit with the highest Medicare surcharge. You follow what I'm saying? And that's probably, you want to make sure that you understand that when you're doing these types of conversions, that you're being mindful of all the income tax ramifications. But that's one we try to keep an eye on with our clients as well.
Thank you. And just a quick note for our listeners, Nick Roth is a member of 3 Core True Wealth Management, just so everyone is aware of that as well. At this point, we do not have any other questions or anyone asking to ask a question. So I'm going to turn over to you, Paul, to close off the session.
Well, thanks again for everybody for joining us. If you think of a question afterwards, feel free to reach out to us. Always helpful to deal with your individual situations and see if we can benefit you. I think the most important item is that it's important for everybody to look at their estate on a regular basis. The changes that are going to be occurring over the next year are likely to be dramatic. When they will occur is the big question mark, but it's very important you look at it so you maximize the amount of money that you can retain, to reduce your income tax, and pass as much money to your heirs as reasonably possible. So thanks again. Thanks to Todd for your presentation, and Joe for organizing this, and for everybody for being here today. Hope everybody continues to stay safe and well and has a great weekend.